In this video, we will be doing a comparison between the Very Good Butcher's Beyond Meat as well as the McDonald's Quarter Pounder Burger, looking at nutritional information. And this is important because we must understand the fundamentals of the Very Good Butcher's and why the product may be superior to Beyond Meat's as well as superior to a traditional quarter pound burger. After that, we'll be going over some Q3 numbers. Then I'll be talking a bit more about their production facilities and future production that the company has once all these facilities come online, and giving you a bit of an idea of what the revenue could be in the future. And lastly, I'll be talking about the recent capital raise that they announced just after the quarterly earnings. Let's talk. What's going on, you guys? My name is Daniel, and here on this channel, we talk about growth stock investing with a focus in the Canadian market. So if you guys are Canadian and you love growth stocks, smash that subscribe button right now for future content on Canadian growth stocks. I cover stocks like the Very Good Food Company, telehealth stocks, as well as just general tech stocks in Canada like Docebo and Lightspeed. If you're a returning subscriber, please leave a like down below before we start. And now, let's get started. So here on the screen, we have the Very Good Burger as well as the Beyond Burger. So if you scroll down to the Very Good Burger and look at some of the information, as well as down on the Beyond Burger, so you can see the product details here. So first, let's go through Beyond Meats. We can look at some of the ingredients here. Water, pea protein, expeller pressed canola oil. That sounds a little weird. I would say that that's not a natural ingredient. Refined coconut oil, rice protein, natural flavors. What are these natural flavors? Cocoa butter, mung bean protein, methylcelluloses. That does not sound very good. That sounds like some sort of manufactured additive that they have in there. Potato starch, apple extract, pomegranate extract, salt, potassium chloride, vinegar, lemon juice concentrate, sunflower lecithin. Not sure what that is. If you know, let me know in the comments down below, as well as beet juice extract. So there's a few ingredients down here that are a little bit sketchy, and I have no idea what they are. They're probably not the greatest for you, but they make it taste like meat, I guess. If we switch over to the Very Good Butcher's, we can see some of the details here. Organic vital wheat gluten, onion, organic black beans, mushrooms, pearl barley, apple juice, carrots, beets, water, organic sunflower oil, celery, tahini, sesame seeds, oats, garlic, nutritional yeast. Not sure what that is. That's probably okay. Apple cider vinegar, organic old-fashioned mustard, seeds, organic apple cider vinegar, sea salt, liquid smoke. Liquid smoke might be a flavoring I think they use. Salt, balsamic vinegar, natural flavor. So I guess they both have natural flavor. Dried shiitake mushroom, herbs and spices, dried porcini mushrooms. So right off the bat, it looks like the Very Good Butchers have more organic ingredients and more natural ingredients compared to Beyond Meats. Now let's turn over to the nutrition facts. So the nutrition label is on a different tab here. So we can see that we're comparing apples to apples in terms of 113 grams each. Calorie-wise, we have 10 more calories in the Very Good Burger versus the Beyond Meat Burger. Total fats, though, look at that. 10 grams of fat versus 18 grams of fat. We've got 5 grams of saturated fat on the Beyond Burger, 1 gram of saturated fat on the Very Good Burger. So fat-wise, definitely the Very Good Burger wins here. Carbohydrates, we got 23 grams versus 5 grams. I guess that's just carbs. Probably better to have less. I'm not a nutritionist, so if you know, let me know in the comments down below. I'd love to hear your opinion if you are a dietitian, for example. But I'm going to take it that less carbohydrates is better. Protein content, 24 grams versus 20 grams. So more protein. So if you guys are working out or anything like that, more protein is better for you. So I think the Very Good Burger wins right there. Sodium, 400 milligrams versus 350. So the Beyond Burger is better in terms of sodium versus the Very Good Burger. And sodium is actually one of the biggest problems with plant-based meats. And you'll see this later on when we look at McDonald's burgers and we compare the sodium content. Looking at all the different vitamin contents here, we can see that the Very Good Burger is rich in that. We've got 85%, 62, 17, and there's not much vitamin content in the Beyond Burger. Now let's jump over to the McDonald's Quarter Pounder. Basically, Quarter Pounder is around 113 grams, so I'm going to assume that apples here in terms of weight. 220 calories, so we have less calories in the McDonald's Quarter Pounder, 16 grams of fat. So it looks like the Beyond Burger has 18 grams of fat versus the McDonald's Burger, meaning that the McDonald's Burger is less fat than the Beyond Burger. But the Very Good Food Company, their burgers only got 10 grams of fat, so you're better off with the Very Good Food Company. As well as saturated fat, 1 gram versus 7 grams. So the McDonald's Burger is worse in saturated fat versus the Beyond Burger. And then when we look at carbohydrates, there aren't many carbohydrates in the Quarter Pounder from McDonald's. Again, 23 grams in the Very Good Burger. Protein-wise, looks like the plant-based meat has more protein than the actual beef. Interesting point there. Sodium, though, look at this, 400 versus, right down here, 210. So basically, the Very Good Burger has double the sodium content. And again, this is one of the biggest complaints from vegans or people who are into plant-based meats, is that the sodium content is extremely high. And I think that's one thing that the Very Good Food Company can work on going forward, reducing the sodium content. Sodium is quite a big problem for plant-based meats, and here's an article that talks about it. So basically, just this paper is saying, study finds meat substitutes need to trim sodium. There's way too much sodium in our plant-based meats, and that's one of the bad parts about plant-based meats. According to the American Heart Association, high sodium diets can increase blood pressure, which may lead to cardiovascular issues, such as greater risk for heart disease and stroke. Recent data suggests that the majority of Americans, 75% of them, are looking for food products that contain lower levels of sodium. So if somehow these plant-based meat companies can reduce the amount of sodium to maybe 1/4 of what they currently have, this would greatly help their case with those people seeking a healthier alternative as well as a more sustainable alternative for the earth. When comparing the McDonald's Quarter Pounder, the Very Good Burger, as well as the Beyond Burger, I'd give the best award to the Very Good Burger still. There's a lot more nutritional content. The ingredients are a lot more natural as well. We have less fat. but the only downside is more sodium. And one more downside about the Very Good Burger is its cost at $11.50. Versus the Beyond Burger, I think I saw that in stores for somewhere around maybe $8 to $10. And then the McDonald's quarter pounder is gonna cost you about $5. So in reality, if you're cost sensitive, you're still gonna go with real meat because it's a lot cheaper than these plant-based alternatives. But if you care about your health as well as you care about the earth, the Very Good Burger is your best option out of the three. And this is one of the main reasons why I'm an investor in the Very Good Food Company. They're still a very young company working on the taste and texture of their foods, and that will only improve over time, but they've started off on the right foot in terms of putting the right ingredients into their burgers, minus the sodium. They've created a very upscale brand, which allows them to sell their products at a higher price, but clearly their ingredients are higher quality, which demands that kind of higher price. And I think once they've established a very good footing in this sector of the market, they're going to branch out maybe with another subsidiary called the Very Good Cheaper Butchers or something like that, where they're going to be marketing more towards the everyday consumer and having a cheaper product, maybe using a little bit lower quality ingredients. However, probably still sticking to the whole brand philosophy of creating something that's healthy and natural. That was a little bit of a longer comparison than I prepared for, but let's move on to the Q3 numbers and see what we can find out there. If you guys don't know the business of the Very Good Food Company, first of all, they have 3 different sales channels. They have their e-commerce, they have their restaurant/retail, and as well as they have wholesale. So this is located in their HQ where they have both a butcher shop as well as a test kitchen/restaurant. So in the restaurant, they serve their current products that are on the market, which you can purchase through the butcher shop or their e-commerce store, as well as they have some special menu items that their R&D team brewed up, and they're testing in this test kitchen to get feedback from customers right then and there. I think this is quite a neat concept where it provides people who come to the actual restaurant with a unique experience. They get to come in, try something new that no one else has ever tried before, give their feedback, and possibly see this product hit the market in the next following months. And this is the appeal for customers to actually go into the restaurant of the Very Good Food Company. And right beside it, they have the butcher shop. And this is where if you tasted something from their restaurant that you really like and you just want to buy it right away, you can go over to the butcher shop and purchase it from the butchers there. The second sales channel is e-commerce, which is basically what it sounds like. You go onto the website, pick all the things that you want, and then check out. One neat thing about their e-commerce solution is that you can go there and order a monthly meat box, which is basically a subscription every single month where they package a meat box for you containing various meats that they offer and ship it to you so that it lasts you for about a full month. You know, it won't last you every single meal, but the idea is that maybe you have 2 meals a week where you use some of these products in the monthly meat box. And currently, the Very Good Food Company says they have about 1,000 subscribers. And if we do some of the math on how much revenue they can generate from 1,000 subscribers, we look at the low end of their boxes, that sells for $47.50. 1,000 subscribers, 12 months a year, that equals to $570,000 per year in revenue from their monthly meat subscriptions. Now, if everyone ordered the high-end box, which is $94.05, then that would mean they would be taking home around $1.13 million in revenue. The likelihood is they probably land somewhere in between, more closer to, I think, $700,000 is my gut feel. People probably buy the lower end box or the mid-tier box, which retails for around $70 to $80. If we compare the subscribers between this quarter and the previous quarter, we can see that they gained about 300 subscribers or 43%. Last quarter was 700 subscribers, and this quarter was 1,000. So if they can grow up 43% quarter over quarter, that is quite an impressive number, and what that turns out to be year over year, they're going to grow their monthly subscribers by 415% year over year, which is quite a phenomenal number for subscriptions to grow. But we'll see going forward if they can actually manage to do that. And for this to happen, they're probably going to be spending a lot of marketing dollars, which we'll talk about a little later on when we look at their financials. For the wholesale business, there's some good news in this earnings report showing that the Very Good Food Company is currently limiting the number of wholesale customers due to production constraints. This is a good problem to have because demand is higher than supply. But supply is also slowly going to ramp up as their new facilities come online, which we'll talk about later on down the road. The next thing that we're going to look at is their gross profit margins. This was around 36.3%, and this was lower compared to previous quarter. And the reason the company gave is because that the logistics companies they worked with didn't manage to ship the products in time, and the food went bad when the customer got it. So they got quite a few customer returns in comparison to the previous quarter. But I think they're tackling this by expanding the number of logistic partners that they're working with so that they're all over the country rather than concentrated maybe in Vancouver. In addition, we know that they have a US expansion, and we're probably seeing a lot more problems in the US as well, where the package has to go through customs and then get on a plane to somewhere else in the States. And there's going to be a lot of time delay there between the factory shipping it out and when the customer actually receives it. Now let's turn over to the operating expenses. And this is where things get a little bit interesting. So first off, we saw the largest increase in expenses from advertising and promotion, going from around $5,000 to $1.2 million, which may be a red flag for some. Then we also had R&D going from $13,000 to $540,000. And lastly, we had wages and benefits go from $130,000 to $615,000. The reason why they're using a lot more funds for advertising and promotion is because they're in the growth stage right now and trying to capture more customers. And this may be a bad thing to some people because they may be like, they're burning a lot of cash trying to get customers, but their revenues aren't exactly reflecting how much they're spending on advertising and promotion. But one thing to note about advertising and promotion is that you can't just win customers with a one-off ad. You usually have to sell that ad to them a few times before they're maybe interested in clicking. So yes, your upfront cost to obtain customers is really high, but then once they're actually customers for life, then as a company, that's when you'll reap in all the benefits. And if those customers really enjoy your products, then you're going to be able to turn those customers into people who advertise for free for you through word of mouth. Next, looking at R&D costs, it makes sense they went from $13,000 to $540,000 because they've ramped up the food scientist team. So when you hire more people, you're going to have to allocate more resources to them, like lab equipment, just materials, and the number of tests that you run. So R&D costs definitely went up, but hopefully this pays dividends later on down the road. And then the wages and benefits, again, that makes sense that it went up because they did hire more staff, not only food scientists, but more production staff, as well as more business staff. Looking at other major expenses, we can see that small tools and supplies at $167,000. This is mainly due to the PPE that they had to provide their production employees. We also had a large expense for share-based payments, and this is because they didn't have a share-based payment plan last year in 2019. It only started very late, which is why we see a nil number here versus $379,000 in this quarter. The professional fees remain just about the same, and I think this is things like auditing financials as well as legal advice. I think last year in September 2019, maybe they were exploring the route of IPOing, so they had a bunch of legal fees and stuff. But now they're a public company, they still have legal fees, and they also do have to get financial audits, like this one that we're reading here. They also have a pretty high fee for investor relations at $186,000, which they didn't have last year because now they're a public company. So that makes sense. Depreciation, I guess they have more equipment, so there's higher depreciation. So that pretty much sums it up for the operating expenses. And there aren't many red flags. Maybe advertising and promotion could be one red flag. And this is because we don't know if it's going to pay off down the road in terms of retaining long-term customers. We're not given any detail in terms of how many people came through advertising and promotion and only did one-off sales versus those people subscribing to the monthly meet club. Now, if we look at the revenue, we can see that it grew by a pretty healthy margin, but mainly that's due to the advertising and promotion, where that probably helped them get a lot more sales in this past quarter, as well as other things like wholesale, which is also doing very well for them. Looking at the revenue for Q3, we can see the revenue grew quite rapidly year over year. I think this is somewhere between 400 and 500% growth year over year, which is very impressive. In their last quarter, I think they released in September, they reported a 395% increase. So it looks like this trend is going forward into this quarter as well. In terms of their current assets versus current liabilities, this current ratio is quite phenomenal. It's well over 2, probably around 4 to 5 right now, where they have 9.67 million in assets, current assets, and 1.6 million in current liabilities. So they have more than enough current assets to cover current liabilities. On top of that, the other day they announced another capital raise for about $10 million, which we'll talk about later on in this video. The cash burn, though, could be a little worrying to investors, where in the past 9 months, they spent $5 million, and they were only able to fund this by raising more capital, which they raised around $13 million in capital. So hopefully going forward, maybe 2 to 3 years down the road, we're going to see them come closer to break even, where the cash that they spend is going to equal the cash that they receive from the operating activities versus financing. And ultimately, as investors, this is where we want a company to go, is to go towards profitability. We want them to no longer raise money from the capital markets to fund their operations. Rather, we hope the revenue from operations will fund their current operations, future development, as well as give some sort of payout in the form of dividends or share buybacks for the shareholders to profit from. Here's one last interesting thing that I found from the earnings report that you should know about the Very Good Food Company if you're going to invest. So the Very Good Food Company engaged with a marketing company to help promote their products through things like Google ads, Facebook ads, and maybe other video advertisements on the internet. And for each sale that this company makes, they earn a commission of $60. So if that customer buys the Very Good Burger for $11.50 and pays for shipping, might end up being around $16 for that, then the company, the marketing company, earns $60 in commission. So the Very Good Food Company will have to fork out $60 plus the cost of goods sold, which is probably around half that or a third of the price. So really they're in the red if the customer only orders once from them. But if that customer becomes a recurring customer, buying about $50 of product a month from the Very Good Food Company, then what the Very Good Food Company pays out to the marketing company doesn't seem as bad. They pay them the upfront $60 for bringing in a new customer and 10% of sales after that. So for $600 of sales throughout the year, that's an extra $60. So a total of $120 goes to the marketing company, and the Very Good Food Company takes home around $450 in revenue. If somehow I get to speak to the CEO again, I'll probably ask him about this marketing deal and see how that's played out for the company then and there. Finally, we're going to talk about the production facilities and future capacity for how much meat they can produce in a single year. So currently the Victoria facility, which is their HQ, test kitchen, and butcher shop, that facility can pump out around 1.375 million pounds of food. And if we take an average price per pound of, let's say, $10, then that will yield them around $13.75 million in revenue a year if they're producing at full capacity. Currently, the company says they're producing around 11,000 pounds of meat per week, and that equals to around 572,000 pounds of meat per year. So they're not even halfway to full production capacity for this facility. The near-term target that management has for this facility is around 19,000 pounds per week, which will equal roughly 988,000 pounds per year. So that's closer to the max production of 1.375 million, but they still have a little bit more ways to go to get there. The next facility that we're going to talk about is their Mount Pleasant facility, which is supposed to be the new HQ in Vancouver. So in this facility, we're going to have the butcher shop, their test kitchen, their restaurant, R&D, as well as manufacturing and distribution. So I don't know the exact manufacturing numbers. If I can find them later on after this video, I'll just post them up on the screen so you know what they are. This facility should be ready in the next 9 to 11 months, so roughly around next year, August. The US facility is probably the most exciting facility for investors because this allows them to sell directly to the US without needing to go through customs. So this facility is actually in Patterson, California, and it's on the same plot of land as their third-party logistics distributor there that they've signed an agreement with. This is key for us investors because there's basically no shipping costs from the manufacturing plant to the distributor. They can literally drive a forklift over from the plant to the distributor and have them put it on a truck or bring it to the airport. The size of this facility initially is going to be 25,000 square feet with an additional 25,000 square feet to come online later on afterwards. And the total amount of space that they could lease going forward, if the expansion goes well, is 500,000 square feet. So that's basically 20 times what they initially will be getting. And with a 25,000 square foot facility, the company reckons that they could produce around 100 million pounds of plant-based meat. And if we multiply that by 10, that's $1 billion of revenue in a single year. Lastly, they have the Rupert facility, which is located also in Vancouver, BC, and this is supposed to come online in Q1 of 2021. And this is the most imminent production facility that's going to come online for the Very Good Food Company. And this facility is around 45,000 square feet, and the amount of production they're expecting to get out of this facility in a single year is 37 million pounds. And multiplying that by 10, we're going to get $370 million of revenue each year once this facility is running at full capacity. So these are some pretty big numbers for the Very Good Food Company in terms of future revenue that they could bring in with these new production facilities. 370 million, 1 billion plus 13 million, that's roughly around $1.4 billion in revenue in a year. Looking at the current market cap, it's around $354 million. And if in the future they can do $1.4 billion in revenue, then that market cap is definitely going to go past $1.4 billion in my opinion, which represents more than a 3x from today's price. Now we're going to talk about the 10 million bought deal offering that they announced, which just got upsized to $13 million. So it looks like the Very Good Food Company increased their bought deal offering from $11.5 million to $13.2 million. However, this increase is contingent on the underwriters buying their over-allotment options of 492,900 units. And this will be at a price of $4.50 per share, which could yield them an additional $1.7 million, which will bring the original $11.5 million up to $13.2 million. Very intends to use the gross proceeds from the offering to fund the commencement of operations at its recently announced new production facility in Vancouver, BC, the Rupert facility. and also for general corporate purposes. So probably just paying wages and paying off debts and stuff like that. This offering is expected to close on or about December 4th. So look out for that date to see if Very actually closes this and how much they end up closing. Anywhere from $11.5 million to $13.2 million. And that's going to boost the balance sheet even more, putting the company in a very good financial position. However, we as shareholders are going to be diluted. And looking at the share price today, it's not too bad because it's dropped back down to $4.17. So I think that if you're getting in right now, it may not be a bad idea to average in at these prices, but I wouldn't exactly go crazy. There's still a lot of risk, and I did mention some of the risk in this video. So if you're looking to invest in Very, dollar cost averaging is your best friend. As for me, I'm still holding my shares. I may buy a bit more into this company, but we'll have to see where the stock goes in the next couple of weeks. To be honest, my price target, what I'm looking to buy in for, is around $3.90. So if we see that, I will be purchasing some Very stock, but if we don't, I'm happy with my position and where it's at. If you guys like this video, leave a thumbs up down below, as well as subscribe and hit that notification bell if you're new here and want to hear more about the Very Good Food Company going forward. If you want to learn more about this company, you can check out this interview with the CEO here, as well as another video on the Very Good Food Company where I do another analysis. If you're there, I'll see you there. If you're not, keep up the grind and have a great day.